Welcome to another deep dive here on Marginal Thoughts.
Great to be here.
Ever heard those whispers, about the super rich or these massive companies, how they seem to barely pay any taxes?
Yeah, it definitely gets talked about.
Well, today we're pulling back the curtain on that whole world. We're diving into tax havens. We want to unpack some, well, maybe surprising facts and figure out how the system actually works.
It's fascinating, isn't it, how this niche area really has such a huge ripple effect on global finance.
Absolutely. So let's start right at the beginning. For those of us just sort of dipping our toes into this, what exactly is a tax haven?
Okay, so simply put, a tax haven is basically a country, or sometimes just a territory, that has very low taxes, or sometimes no taxes at all,
Right.
especially for people and businesses who come from, other places. Think of it like a financial safe harbor.
A safe harbor. Okay, that makes sense. So it's not necessarily that these places are like naturally super wealthy themselves.
Exactly. No, the name might make you think of, I don't know, paradise or something. But the core idea is offering a refuge from higher taxes somewhere else.
Hmm.
And it's important to know there isn't one single official definition that everyone signs up to. It's a bit fuzzy.
Okay, so the main draw is the low or zero tax. Got it. But what else makes a place attractive as a tax haven? Is it just the money side?
Well, no, not entirely. Beyond the low tax rates, these places usually offer really strong financial privacy.
Privacy. How so?
Their laws are basically designed to shield the identities of the people and the companies who keep their money there. Plus, they tend to be politically and economically stable.
Ah, stability. Right.
Yeah, that gives a sense of security for the assets, that are held there.
Interesting. So it really does sound like a deliberate strategy, doesn't it, to attract wealth from elsewhere?
Very much so.
Now, something that struck me when looking into this, despite their kind of modern, sleek image, tax havens are actually, well, relatively new in the grand scheme of things.
That's right. Yeah, they didn't really become a major phenomenon until around the start of the 20th century.
So what happened then? What was the trigger for them popping up relatively recently?
Well, their growth is really closely linked to something else that was happening around that time. The introduction of income taxes.
Ah,
Yeah,
yeah.
late 1800s, early 1900s, lots of countries started bringing in income tax. And, well, as soon as government started taxing income, tax havens sort of emerged as the escape route, you could say.
An escape route for who? Mainly.
Primarily for those with significant wealth. They gave them a way to legally reduce the amount of tax they had to pay.
Right. So who were the early players? Who sort of jumped on this idea first?
Switzerland was definitely one of the pioneers.
Switzerland. Okay.
Yeah.
Why them?
Well, a couple of things. They had this long-standing policy of neutrality, which was already attractive.
Right. In world wars and things.
Exactly. And then combined with that, certain regions, certain cantons like Zurich, Zug, and nearby Liechtenstein too, they developed these very business-friendly tax rules.
So it became a fiscal paradise, as they say.
Pretty much. And it wasn't just about secrecy back then. It was also about providing that stable, neutral haven in what was becoming a pretty volatile world. It made it uniquely attractive for, long-term wealth preservation.
That's a really interesting angle, neutrality playing a role in finance. Okay.
Absolutely. And then something really solidified their role. The Swiss Banking Act of 1934.
What did that do?
It offered just unprecedented levels of secrecy, basically, for bank clients.
Yeah.
That essentially turned Swiss banks into these vaults for global money.
Wow. Okay. So Switzerland kind of set the template. Who else got into this game early on?
Well, over in Europe, you also had Monaco.
Ah, the French Riviera. Very different vibe, I imagine.
Yeah, a bit different. Monaco's approach was maybe less about pure secrecy and more about the lifestyle. They offered zero income tax, which was huge. Zero income tax. Plus, the glamorous lifestyle, the marinas, the whole package.
So Switzerland was selling discretion. Monaco was selling the dream, kind of.
You could put it that way, yeah. And then, a bit later, we see the Caribbean islands becoming really significant players.
Right. You hear about places like Bermuda, the Bahamas.
Exactly. They became major centers by offering things like shell corporations.
Shell corporations. We hear that term a lot. What are they exactly?
Basically, they're companies that exist only on paper. They don't have a real office, no employees usually. They're just a legal structure.
Okay, just a name and a registration somewhere.
Pretty much. And places like Bermuda and the Bahamas also specialized in things like asset protection trusts. These are specific legal setups designed to shield assets from say, future lawsuits or creditors.
Right.
They use the particular laws of those islands.
Okay, shell companies and trusts. We should probably dig into those a bit more later. What made the Caribbean specifically so appealing beyond those tools?
Well, they innovated. They started offering a much wider range of financial services than maybe the early European havens.
Yeah.
And they put a really strong emphasis on secrecy.
Secrecy again.
Yeah, it's a recurring theme. And they timed it well, capitalizing on the economic boom after World War II.
Mm.
People and companies just had more wealth they needed to manage or, shelter.
And the Cayman Islands often comes up too, right?
Yes. The Caymans really carved out a niche for themselves. They've focused specifically on regulating banks and trust companies very effectively. That specialization helped them become this massive global financial center, especially for things like hedge funds.
Okay, so we've got Europe, the Caribbean. Are there other important spots on the map we should know about?
Definitely. Back in Europe, there are some other, maybe less flashy, but still very significant players. Luxembourg, for instance.
Luxembourg, what's their angle?
They offer quite low tax rates and some specific benefits around value-added tax, or VAT. But the really unique thing about Luxembourg is its EU membership.
Ah, so that gives it access.
Exactly. Access to the huge European market. So it's not just about low tax, it's being a gateway.
Clever. Any others in Europe?
Well, not quite Europe, but closely linked. Hong Kong?
Asia?
Right. Former British colony, of course. It has no income tax, no capital gains tax, and operates within a familiar British legal framework. Plus, it's a major free port.
Free port. What does that mean in this context?
It means you can store valuable goods there. Think artwork, gold, fine wine, without paying import duties or taxes. It's like a tax-free warehouse.
Gotcha. So not just financial assets, but physical ones too.
Precisely. And Singapore is another key player in Asia, offering similar free port advantages. It also has this growing reputation for political stability, which is increasingly important for people looking to safeguard wealth long term.
Okay, let's swing back to Europe for a sec. Ireland comes up a lot, especially with tech companies, but it doesn't sound like a zero tax place.
No, Ireland's a bit different. It's not zero tax, but it established itself as a corporate tax haven. It set its main corporate tax rate at 12.5%, which was, well, very low compared to many other developed countries.
12.5%, okay.
And crucially, they offered even lower rates, sometimes effectively near zero, for profits generated from intellectual property, like patents and software rights.
Ah, and that's why the big tech companies flocked there.
That's been a huge factor, yes. Attracted many of the world's largest tech firms.
And just across the water from Ireland, there's Jersey.
Right, Jersey. It's a British Crown dependency, so it has its special status. For individuals, the maximum income tax is 20%, which is attractive to some high earners. But the big draw for businesses is that most companies pay no corporate tax there.
Zero corporate tax. No.
Okay. Yeah, it makes it very appealing for financial services companies in particular, but also for individuals setting up holding companies.
Okay, one more, and this one might surprise some people listening. The United States, Delaware.
That's right. Delaware isn't an offshore island, obviously, but it often gets called a sort of tax shelter right within the U.S.
Why is that?
It has a very, very business-friendly court system, specialized in corporate law. And importantly, it doesn't charge state income tax on the profits of companies that are registered there, but don't actually do business within the state of Delaware itself.
So you can be legally based there but operate elsewhere.
Yes. And then there was the famous Delaware loophole, though it's been somewhat closed now. It related to how companies could shift income from intangible assets, like trademarks, to Delaware to avoid state taxes elsewhere.
Wow. Okay. So the geography is pretty widespread. Now, for those of us still getting our heads around this, can we maybe break down some of the actual methods used? You mentioned shell companies, like the tricks of the trade for beginners.
Sure, yeah, let's try. So shell companies are fundamental. As we said, they're basically companies on paper, registered in a tax haven, often with no real office or staff there.
Just a mailing address, maybe?
Sometimes just that. But don't let the simplicity fool you. These entities can be layered, one owning another, making it incredibly hard for tax authorities or investigators to figure out who ultimately owns the assets held by the company.
So they're used for hiding ownership.
That's a major use, yes. Or simply to hold money or investments in a place where the profits won't be taxed, or taxed very little.
Okay, so that's one tool. What's another common one?
Another key mechanism involves something called controlled foreign corporations, or CFCs.
CFCs.
Yeah. These are essentially overseas subsidiaries set up in tax havens by a parent company that's based in a higher tax country.
Okay.
And the goal is,
The main goal is usually shift profits from the high-tax parent company to the low-tax CFC, and so, pay less tax overall.
you mentioned Apple in Ireland earlier. Was that related to CFCs? Yes. That was a classic, though very complex example. Apple used companies registered in Ireland, which were effectively managed from the U.S. They exploited differences or loopholes between U.S. and Irish tax law about where a company is considered resident for tax purposes.
So, based on registration versus management.
Exactly. For a time, this structure allowed certain profits to arguably not be taxed substantially in either country. It was very controversial.
Sounds like playing the rule books against each other. What's another common tactic people might hear about?
Transfer pricing. This one gets a bit more technical, but the basic idea is moving money between different branches of the same multinational company that are located in different countries.
Internal transactions, you mean?
Exactly. Through internal transactions. So one branch might pay another branch for, say, using the company's brand name, a royalty payment. Or it might pay for management services, or even just the price they sell goods to each other internally.
Okay, and how does that save tax?
Well, the company can essentially set the price for these internal transactions strategically. They can inflate the price of things being paid from a high-tax country to a low-tax country.
Can you give us a really simple example?
Okay, imagine. Let's call it Wee Wee Shoes, based in the U.S. where corporate tax is, say, 21%. Wee Wee Shoes sets up a tiny branch, maybe just a shell company, in the Cayman Islands where the tax rate is 0.
Right.
Then, Wee Wee Shoes legally transfers the ownership of its valuable brand name and maybe its shoe designs to the Cayman branch. Now, the U.S. part of Wee Wee Shoes has to pay big royalties to its own Cayman branch for the right to use its own brand and designs on the shoes it sells.
So it's paying itself, essentially.
Kind of, yeah. But those royalty payments count as a business expense in the U.S., which reduces the taxable profit of the U.S. operation.
Lowering the U.S. tax bill.
Exactly. And meanwhile, those big royalty payments pile up in the Cayman branch, completely tax-free. So the overall global tax bill of Wee Wee Shoes goes way down. It's about artificially shifting where the profits appear to be made.
Got it. It's like one part of the company deliberately overpaying another part in a tax haven.
That's a good way to think about it, yeah. Finally, another structure we should mention is trusts.
Trusts?
These are legal arrangements. Basically, someone, the settlor, gives assets to someone else, the trustee, to hold and manage for the benefit of other people, the beneficiaries.
Okay, I think I've heard of trusts for inheritance and things.
Yes, they're used for many legitimate purposes. But in a tax haven context, someone might place their assets, money, property, investments into a trust that's legally based in a low-tax or no-tax jurisdiction.
And the benefit there is?
Depending on the specific laws of the haven and how the trust is set up, it can potentially reduce or completely avoid certain taxes, like maybe capital gains tax when investments are sold, or inheritance tax when assets are passed on.
So if I put my stock portfolio into a trust in a place with no capital gains tax, I might not pay tax when the stocks are sold at a profit.
That's the kind of advantage people might seek, yes. Trusts can be very effective tools for holding significant wealth and minimizing taxes, depending on the jurisdictions involved.
This is really starting to make sense, seeing how these pieces fit together. Now, flipping the perspective, why would a country actually want to be a tax haven? It sounds counterintuitive, like they're giving up tax revenue.
That's a really good question. And you're right, it seems odd at first, but often these are smaller countries, maybe islands or nations with limited natural resources or other major industries.
So they need something to build their economy on.
Exactly. Developing a financial services industry by offering low taxes and secrecy can be a very deliberate strategic economic choice for them. It becomes their niche.
So it's basically a business model for the country itself. How do they make money then, if not from taxes?
They earn revenue in other ways, through fees mainly. Fees for registering all those thousands of shell companies, banking license fees, fees for managing trusts.
Okay. Little bits from lots of transactions.
Precisely. And sometimes they do charge a very small percentage tax, but on absolutely enormous amounts of money flowing through. So even a tiny rate on trillions of dollars can add up to significant income for a small country.
And I guess it creates jobs, too.
Oh, absolutely. The growth of this financial services sector leads to well-paid jobs in banking, law, accounting, trust administration, and all the support services around them.
Okay, but let's get into the other side of the coin now. Why is this whole system so controversial? What's the broader impact?
Right. This is where it gets, well, pretty contentious. A major criticism is the sheer amount of tax revenue that other countries lose out on.
The countries where the money was actually made, you mean?
Exactly. When individuals and especially large corporations shift profits and assets to these low-tax havens, the countries where the actual economic activity happened, where the factories are, where the sales are made, they don't get to tax those profits fairly.
And who feels the pinch from that lost revenue?
Well, ultimately, it's often the general public in those higher tax countries. Less government revenue can mean less funding for public services. We all rely on schools, hospitals, roads, you name it.
So it could mean cuts to services or...
Or it could mean that taxes have to be higher for everyone else, particularly maybe the middle class and smaller businesses that can't use these complex offshore structures just to make up the shortfall. It can definitely worsen inequality.
Yeah, I can see that. It sounds like a system that could be pretty easily abused, too.
It certainly can be. That high level of secrecy we talked about, that's not just attractive for legal tax avoidance. It can also be exploited for clearly illegal activities.
Like what?
Money laundering is a huge one. Using the secrecy and complex structures to disguise the origins of dirty money from drug trafficking, corruption, organized crime, and make it look legitimate. And just generally hiding illegal income from tax authorities. You might remember the Panama Papers leak a few years back.
Yeah, that was massive.
That really shone a light on how these structures could be used to hide wealth, sometimes linked to illicit sources or tax evasion.
And the scale of this, the amount of money involved must be staggering.
It really is. Estimates vary because it's so hidden, but organizations like the Tax Justice Network estimate that global tax avoidance and evasion by corporations and individuals costs governments worldwide something like $700 billion a year.
$700 billion every year.
That's one prominent estimate, yes. And you see examples of major, well-known companies holding vast sums, offshore companies like Apple, Nike, Google, Microsoft, IBM, GE, ExxonMobil, Chevron, Walmart. The list goes on.
Wow.
The total amount of private wealth just held offshore, hidden away, is estimated to be in the trillions of dollars, maybe tens of trillions.
Trillions. It's hard to even comprehend.
It is. And another really important point is the impact on developing countries. They often lose a much higher percentage of their national wealth to offshore havens compared to richer countries.
Why is that?
Often due to weaker tax enforcement domestically, perhaps more corruption, and the fact that wealth extracted from their natural resources might be funneled offshore more easily by elites or foreign companies. That loss of revenue massively hinders their development potential.
That's a really grim side effect. So, given all these problems, what's being done internationally? Is anyone trying to rein this in?
Yes, there are definitely ongoing efforts. It's become a much bigger political issue in the last decade or so. International organizations like the OECD, the Organization for Economic Cooperation and Development, and the G20 group of major economies are leading the charge.
What kind of things are they doing?
One major initiative is called the Base Erosion and Profit Shifting Project, or BEPS. That's aimed squarely at stopping companies from exploiting those gaps and mismatches in tax rules, like the transfer pricing and CFC stuff we talked about, to artificially shift profits away from where they're actually earned.
So, trying to close the loopholes?
Essentially, yes. And alongside that, there's been a huge push for more transparency.
How are they achieving that?
A key mechanism is the Common Reporting Standard, or CRS. This is an agreement where over 100 countries now automatically exchange financial account information with each other.
Automatically. So banks in one country tell the tax authority in another country about accounts held by their residents.
That's the idea. It makes it much, much harder for individuals to just hide money in an undeclared offshore bank account without their home tax authority finding out about it.
Okay, that sounds like a big step. What else?
Well, the European Union has created blacklists and gray lists of countries they consider to be non-cooperative tax jurisdictions. Being on the blacklist can trigger certain sanctions or make it harder for EU funds to flow there.
Putting pressure on the havens themselves.
Exactly. And perhaps the most ambitious recent development is the move towards a global minimum corporate tax rate.
A minimum rate everywhere.
That's the goal, pushed heavily by the OECD and G20. Over 130 countries have signed up to a framework that includes a minimum effective corporate tax rate of 15%. The idea is to reduce the incentive for companies to just shift profits to the lowest tax place they can find, because even there, they'd still have to pay at least 15%.
So trying to stop the race to the bottom on tax rates.
Precisely.
Yeah.
It's still being implemented, and there are complexities, but it's a significant shift in global tax policy.
It definitely sounds like there's a global push for More accountability, more transparency.
There certainly is much more international focus and political will to tackle these issues than there was, say, 20 years ago.
Right.
But the world of international finance is incredibly complex and dynamic. Tax havens and the advisors who use them are very adept at finding new loopholes or adapting to new regulations. So it's likely to be an ongoing cat and mouse game.
Yeah, I can imagine. So, as we kind of wrap up this deep dive, where does that leave us? What's the big takeaway? Is this system, a legitimate tool for managing finances, or is it fundamentally a flaw, a problem in how global money works?
That really is the crux of the debate, isn't it? And there's no easy answer. On one hand, some argue quite strongly that individuals and businesses have a legal right to arrange their affairs to minimize their tax burden. They'd say tax havens offer efficiency, privacy, maybe even protection from unstable governments, and foster competition between countries.
The tax competition argument.
Right. On the other hand, critics point to the enormous scale of lost revenue, the impact on public services, the way it fuels inequality, and its undeniable role in facilitating crime and corruption. They argue it undermines the social contract and the ability of governments to function effectively. And that impact on developing nations is, I think, a particularly powerful counterargument.
Definitely a lot to weigh up there. It's not black and white at all.
Not at all. Hopefully, though, this discussion has given you, our listeners, a clearer picture of what tax havens are, the main ways they operate, and some of the really big controversies and debates surrounding them.
Absolutely. I feel like I understand mechanics much better now. Thanks so much for breaking down such a complex topic for us.
It was my pleasure. It's important stuff to understand.
So, what do you think about all this? The world of tax havens, are they a necessary evil, a legitimate strategy, or just a fundamental problem we need to fix? Let us know your thoughts down in the comments. We genuinely love hearing your perspectives.
Yeah, please do share your views.
And if this deep dive got you thinking, make sure you subscribe to Marginal Thoughts. We do explorations like this all the time, digging into the forces that shape our world. There's always more to unpack.